This is Quint Bilo with an introduction to long-term liabilities. We'll be covering bonds in this chapter primarily, and we'll first discuss bonds in general, get a good basis in this before we hit some of the heavy-duty journal entries related to this topic. So we'll talk about the type of bonds, some general issuing procedures, and the market price of bonds, that is, the selling price of bonds. There'll be a separate discussion of the different scenarios of journal entries required for the issuance of bonds when corporations sell them. Okay, how many ways are there for a corporation to obtain cash? First, it can sell stock. We covered that in the prior chapter. When it sells stock, debits cash, credits stock accounts paid in capital. Or it can borrow from a bank, increasing cash with a debit, increasing notes payable with a credit. Or it can borrow from you and I, debit cash, credit bonds payable by issuing bonds, or can earn a profit. We're concerned with item number 3 in this chapter. We are accounting for a liability, bonds payable, by selling bonds for cash, which requires a repayment upon maturity. So we're talking about raising capital by borrowing from you and I who can purchase the bonds of a corporation, rather than issuing stock, rather than borrowing from a bank. Bonds are a form of interest-bearing notes payable. There are 3 distinct advantages to issuing bonds versus issuing common stock. First, stockholder control is not affected. We're not issuing more shares of stock, diluting our interest. Second, a tax saving may result. The interest cost of bonds is deductible. Dividends are not deductible in determining net income. Third, return on common stockholders' equity may be higher when issuing bonds for raising capital. Again, stock is not increased, but rather a long-term liability is increased, bonds payable. As noted at the bottom, bonds can be issued by more than corporations. They can be issued by governmental agencies or universities to raise capital. This shows the effects of earnings per share under a corporation that issues stock versus one that issues both stock and bonds. Under Plan A, there's 300,000 shares of common stock issued. That's the only major capital raised by the corporation, and shows a scenario of earning $1.5 million before interest and taxes. Both Plan A and Plan B have the same earnings before determining other factors. Under Plan A, we see that the earnings per share after payment of income taxes is $1,050,000 divided by 300,000 shares of stock, $3.50 per share. Now take the same corporation earning the same amount of money, $1,005,000 before interest and taxes, but if a corporation issues bonds, we'll have a bond interest expense deduction, which reduces taxes. Net income in this scenario is lower than net income under Plan A, where there is no bond issuance. However, look at the earnings per share, $7.70 per share versus $3.50. Why? The corporation chose to issue bonds to raise capital rather than stock. The stock would have diluted it by raising the shares from 100,000 to 300,000. In this case here, the capital is obtained by a combination in Plan B of issuing less shares outstanding but bonds payable. So from an owner perspective, earnings per share is higher even though net income is lower, because ownership was not diluted by issuance of additional stock. Plan B, the capital for the corporation was a combination of a lower amount of stock and bonds payable. Plan A, strictly issuing stock to owners. Higher earnings per share under Plan B, issuing bonds. A definite advantage to issuing bonds to raise capital. Review question. Major disadvantages resulting from the use of bonds are that interest must be paid and principal must be repaid. Unlike issuing stock, the corporation doesn't have to buy back that stock. Issuing bonds, the principal amount is repaid to bondholders and interest along the way. The type of bonds are described in the textbook, and I'll let you read over those. I'm going to primarily concern myself with unsecured debenture bonds. debenture bonds are bonds issued against the general credit of the borrower, also called unsecured bonds. What is a bond? It's a contract. A contract called a bond indenture. The issuer, which is a corporation, promises to repay the principal at maturity and interest along the way to a holder or buyer of the contract. So a buyer of a bond loaning money to a corporation will receive interest payments along the way and repayment of the principal amount at the end of the term of the bond. Let's look at some key terms in a bond contract. The borrower, the issuer of the bond, a business such as a corporation, will primarily be concerned about accounting from a borrower's perspective in this chapter. A lender, the holder of the bond, individuals such as you and I, people who loan money to a corporation. A bond amount, the principal or face value of the bond. This is stated on the bond itself. It has a value on the bond itself is stated, such as a $1,000 value. Maturity date, the date at which the issuer, that is the borrower, repays the principal amount or face amount of the bond. Issuance price, normally expressed as a percent of face value, such as 100%. If a bond is sold at face value, we call it a selling price of 100. If a $1,000 bond is sold at $980, we call it a priced at 98. So the issuance price is the selling price of a bond. It might not be the face value. When that occurs, we have more complicated accounting to deal with. Bond interest rate. This is the coupon rate or a fixed rate that's paid to bond holders. This is on the face of the bond itself, and the amount interest paid is fixed, irrespective of the selling price of the bond. Part of the contract. Bonds are issued for fixed terms, normally longer than 10 years. Interest is the main cost of the bond contract to the borrower. Interest payments are fixed. They're fixed according to the bond interest rate stated on the bond times the face amount or principal amount of the bond. So it's a contractual contract on paying interest, as indicated, face times fixed coupon rate. Yet, interest payments are not necessarily equal to the interest expense of the borrower. This depends on the selling price. So payments are always the same, but the interest expense recognized by the borrower may be different than the payment based on selling price. We'll get into that later. Note this distinction: the face or principal amount of a bond versus the selling price of the bond. They can be different than the face value. This is somewhat similar to a manufacturer's suggested retail price of a car versus the final selling price. If the MSRP is $20,000, but the buyer is willing to pay on $19,000, that can exist. Why the difference? The buyer doesn't find the car attractive at the full $20,000 price. What are bondholders wanting? Well, they're investing their money for the interest amounts they obtain and a repayment of the principal. So bonds pay interest to the holder, but it's a fixed payment per the contract. Again, as stated, face amount of the bond times the stated coupon rate is the amount of fixed payments. That fixed interest payment changes everything. What do I mean? The yield the holder obtains is based upon what they pay, what they invested for the bond. Let's explain that further. A yield definition: what you get for what you give up, or what you invest. In other words, how much interest payments you're receiving for how much it cost you to buy that bond. So it's a fixed amount of interest received because the interest paid by the borrower to a bondholder is fixed, divided by the amount invested, gives the percent yield of that bond. The amount invested is the selling price of the bond. How is yield changed if interest payments are fixed? We change the denominator, the amount invested. Different bond selling prices give rise to different yields. In a later discussion, we'll see that different selling prices give rise to different interest expense recognized by the borrower, even though the amount of interest paid periodically is the same, fixed by contract. For example, why would someone buy a bond that pays 4% interest when another bond with the same risk pays 6%? Remember, the stated interest rate is fixed on bonds. We will not be dealing with floating interest rates in this course. So that's why the selling price on bonds can be different than face value. The selling price becomes an equalizer. If you change the selling price, you change the yield that the lender is obtaining by their investment. So we can easily change a 4% bond by contract, the fixed coupon rate, to act like a 6% bond simply by lowering its cost or selling price. That's the amount invested by the buyer or bondholder. So the cost of bonds determines the yield along with the fixed interest rate paid. Let's look at some issuing procedures of bonds. As we saw, it represents a promise to pay back the lender. A sum of money at a designated maturity date, that's the face amount or principal amount, plus periodic interest at a contractual fixed rate on the maturity amount or face values. Interest payments are usually made semi-annually by convention. Here's an example of a bond. We are looking at the face of the bond. We see that's a $5,000 face value, upper right-hand corner. Issuer is International Minerals and Chemical Corporation. The maturity date is identified as May 1 of 2018. We see the contractual rate shown here at 11.875%. And we also see the face value printed out in the middle of the bond, $5,000. This one bond has a $5,000 face value. What does that mean? Someone buying this bond, other than getting $5,000 back in the year 2018, along the way will receive fixed interest payments of 11.875% times $5,000 each year. And commonly, the interest will be paid semi-annually. So they'll earn that 11.875% annually in two separate payments 6 months apart. How are the market values of bonds determined? The market value, also known as a selling price, is a function of three factors. The dollar amounts to be received, the face value at the maturity, the length of time until the amounts are received, 5 years, 10 years, etc., and the market rate of interest. We will be mainly concerned with the market rate of interest in determining different selling prices. The market rate of interest is the rate demanded by the buyer of a bond. By the way, I want you to note that the selling price of a bond is a present value concept. What does present value mean? Well, a dollar received today is worth more than that same dollar received 1 year from today. That is, there's a relationship between time and money. Corporations record bond transactions at the following times: when they issue it, when they sell the bond, and when they retire it, buy it back or redeem it. I'll not concern myself with bondholders converting bonds into common stock in this course. A note at the bottom: if bondholders sell their bond investments to other investors, the issuing firm receives no money on the transaction. It's between the owner of the bond and the new purchaser of the bond. So the issuing corporation does not journalize any transactions if a buyer of a bond sells it to someone else privately. That will not be a concern in this chapter. So, general transaction. Corporation sells bonds. When it sells it, what's the corporation entry? Debit cash. In this case, we're assuming $100,000 worth of bonds. Credit bonds payable. Cash goes up with the debit. Bonds payable, a liability, goes up with the credit. This is all about borrowing, which must be repaid. This is a very simple case here. We obtain an asset, cash, and we record a liability. This simple case here assumes that the bond was sold at face value, or $100,000. Along the way, this bond will pay fixed interest costs, commonly every 6 months. The issuing corporation, when it pays it, will debit interest expense and credit cash as it pays the bondholder. Again, the interest is earned and paid during the term of the bond. At the end of the term, the maturity or face value is paid back to the bondholder. This is a borrowing that must be repaid. Let's talk a little bit about the selling price of bonds. Not everything sells for face value or principal amount. Three different scenarios can exist. We'll look at all three in this chapter. Selling at face value, that's the very simplest accounting. We just looked at that in the previous slide. We can sell below face value, or we can sell above face value. Whatever price a specific bond sells for, the interest payment received by the bondholder is the same. That is fixed. However, the yield that the bondholder is receiving is based on how much they paid for the bond. This diagram demonstrates three different scenarios determining what value a bond is issued or sold at. Is it sold at face value? Is it sold at a discount or sold at a premium? What do these terms mean? It all starts with what's the contractual interest rate, the coupon rate on the bond. In this case here, we're assuming 10%. That's a fixed rate. So whatever is paid by the bondholder, they're going to get an interest based on 10% times the face value of the bond. Now, let me go for the middle scenario here. If the market interest rate is the same as the contractual coupon rate, or 10%, the bond will sell at face value. It'll sell for the face amount of the bond. If interest rates are lower, in other words, if current bondholders are demanding less than what the coupon rate is paying, those bonds will be very attractive, and those bonds will sell at a premium. That is, they'll sell for higher than the face value. Again, the selling price equalizes the market interest rate demanded by a bondholder and the coupon fixed rate on the bond itself. Again, we mentioned if the market rate is 10% at the time the bond is sold and the contractual rate is 10% coupon rate, it will sell at face value. In the last scenario, if the market interest rate is 12%, that is, the current market is paying 12%, bondholders demand 12% for their money invested, but the bond they're looking at only has a coupon rate of 10%, it will not be attractive to them. What makes it attractive? Discount the bond. Sell it at less than face value. Equalize the 12% market interest rate and the fixed coupon rate of 10% by lowering the price of the bonds. The selling price of bonds literally equalizes the market rate demanded by a bondholder versus the fixed rate on the bonds themselves. When corporations issue bonds, it typically takes months to put a bond offer together. The corporation can estimate what the market rate will be when it finally issues it months later. However, interest rates can change daily in the market. That's why bond selling prices will vary if the corporation doesn't exactly estimate what the market rate will be when it finally issues it months later. These three scenarios will be further discussed in another talk on this chapter.